Hello guys, how are you? Okay, this video is the continuation of the last video regarding financial ratios. In the last uh, video, we discussed about the introduction and we further discussed about profitability ratios. Now today we are going to focus on working capital ratios. Now what is working capital? Working capital is actually the capital you're using for day-to-day operations. In the form of formula, it can be said that working capital is equals to your current assets minus current liabilities, the amount that is remaining that you are actually using as in your operations, in your day-to-day operations. That is why it is called working capital. Now, working capital efficiency ratios measure the efficiency with which the entity has managed its receivables, inventory, and trade payables. Excessive investment in working capital is indicated by a long cash cycle, also called a long working capital cycle, that appears to be getting even longer. When too much is invested in the working capital, the return on capital employed and return on shareholders' capital will be lower than they should be. It means that they won't be happy. Okay, we will discuss cash cycle later on. On the other hand, underinvestment in working capital is an indication of possible liquidity difficulties, means company may be out of cash. When working capital is low in comparison with industry average, this might indicate that current assets are being financed to an excessive extent by current liabilities, particularly trade payables and a bank OD. Now let's discuss different ratios in working capital efficiency ratios. The first one is average time to collect. That's receivables days or days sales outstanding. Means the average time period that after which you actually receive cash from your customers. This ratio estimates the time it takes on average to collect the payment from customers after the sales has been made. It could be described as the average credit period allowed to customers or the average collection period. Average time period to collect is equals to trade receivables over credit sales into 365 days. Now they can even be expressed in months or weeks as appropriate. Trade receivables should be the average value of receivables during the year. This is the average of receivables at the beginning of the year and receivables at the end of the year. However, the value for receivables at the end of the year is also commonly used. Sales are usually taken as total sales for the year. However, if sales are analyzed into credit sales and cash sales, it is probably more appropriate to use the figure for credit sales only. The average time to collect money from credit customers should not be too long. A long average time to collect suggests inefficient collection of amounts due from receivables. It may indicate inability of the performance of recovery department or inconsistent use of credit policies. Let's move forward towards average time for holding inventory or inventory turnover. This ratio is an estimate of the average time that inventory is held before it is used or sold. Average inventory days is equals to inventory over cost of sales into 365 days. In theory, inventory should be the average value of inventory during the year. This is the average of the inventory at the beginning of the year and inventory at the end of the year. However, the value for inventory at the end of the year is also commonly used. A long average inventory holding period may increase holding costs and cash tied up to it is recovered when inventory is actually sold. Secondly, due to long inventory holding periods, inventory may need to be provided for example, in case of short expiries. Actually, you might have visited stores where actually the products that are about to expire, they are placed in promotional areas, means that you are selling goods at a considerably lower rates. So that's why. Okay, let's move forward. Average time to pay suppliers. Now its formula is average payment days is equals to trade payables upon purchases into 365 days. Now trade payables should be the average value of the trade payables during the year. This is the average of the trade payables at the beginning of the year and trade payables as at the end of the year. However, the value for trade payables at the end of the year is also commonly used. When the cost of purchases is not available, the cost of sales should be used instead. This figure is obtained from the P&L information in the statement of comprehensive income. A long average payable holding period may provide companies to make most use of their available funds, but on the other hand, company may lose attractive discounts on early payments and may even impact goodwill of companies among suppliers. The turnover ratios, also known as multiples. Turnover ratios can be used as an alternative way of telling the same story as the efficiency ratios. These show the number of times a balance in the statement of financial position is turned over in the period. They are multiples which provide the same insight as the efficiency ratios but in a different way. Now let's just see formulas to further understand it. Receivable turnover is equal to credit sales over trade receivables. It will actually give you the number of times the receivables actually converts into cash within a year. Secondly, inventory turnover, cost of sales upon inventory. Payable turnover, purchases upon trade payables. Now these turnover ratios would actually be linked with the cash operating cycle we are going to discuss now. Now let's discuss the cash operating cycle, also known as working capital cycle. The cash operating cycle or the working capital cycle is the average time of one cycle of business operations from the time the suppliers are paid for the resources they supply to the time that cash is received from customers for the goods or services that the entity makes or provides with those services and then sells. Let's mathematically see what's actually cash operating cycle. Cash operating cycle, average inventory holding period, then you add upon it average trade receivables collection period, and then you deduct average period of credit taken from suppliers. Now operating cycle, now the end figure will actually tell you the amount of cash that you will receive in a year. This will actually tell you the number of days in which actually you will receive cash. The working capital ratios and the length of the cash cycle should be monitored over time. The cycle should not be allowed to become unreasonable in length, with the risk of over-investment or under-investment in working capital. A positive working capital cycle balances incoming and outgoing payments to minimize net working capital and maximize free cash flows. For example, a company that pays its suppliers in 30 days but takes 60 days to collect its receivables has a working capital cycle of 30 days. This 30-day cycle usually needs to be funded through a bank operating line, and the interest on the financing is actually a carrying cost that reduces the company's profitability. Growing businesses require cash, and being able to free up cash by shortening the working capital cycle is the most inexpensive way to grow. Sophisticated buyers review closely a target's working capital cycle because it provides them with an idea of the management's effectiveness at managing their balance sheet and generating free cash flows. Now, this ends our discussion related to this working capital efficiency ratios. Now, if you need further assistance, you can subscribe to our channel and you can actually comment it. We'll provide you further guidance in the form you need. Thanks, and in the next session, we will discuss further categories of financial ratios.